Match stock analysis. What is going on, guys? Welcome into this video today. These Saturday videos, this is where I break down everything about the company that I've been looking into for however long, whether it's been a couple days, couple weeks, whatever the case may be. I do a full stock analysis breakdown video. I'll go over the business model, the balance sheet, my thoughts, whether they're bullish or bearish, where I see this company going, things I like, things I dislike, everything in between. Before we get into the content, guys, I just want to say thank you to everyone that's subscribed so far. Thank you so much for 400 subscribers. Soon we'll be at 500, then we'll be doubling that, we'll be at 1,000. I really just want to thank every single one of you that tune into every video, that like the video. I appreciate every single one of that. And saying that, shameless plug, if you like this video, if you do get some content out of it, please like the video. That really does mean a lot to me. It really does help me out a massive way. It really helps the channel grow, and it really helps push these videos out to a newer audience, and it just brings more people to the channel and just helps more people get value out of this content I've been putting out. Also, if you haven't yet, this is your first time here, welcome. Please subscribe. I'd love to have you to hit that subscribe button, turn on that notification bell so you don't hit any future uploads. Anyway, Match the stock, which I'm very bullish on. I'll put that out there right now. Full disclaimer, I'll just put it out there immediately right from the jump. I really do like this company. It's a stock I wouldn't mind getting involved with, but I do need that valuation to come down a little bit before I get involved with this stock. I'll go over in a little bit what I need that valuation to be at and all of that jazz, but for right now, that's all I'm going to leave it as, and let's just get right into the content, guys. So Match was actually affiliated with IAC, or Interactive Corp, up until about June of last year. IAC is a whole different part of their business, which we're really not going to get too much into right now because they're separated now, so it's not a huge part of it, or it's really not any part of it, really. But Match is kind of like more so a monopoly of all these dating platforms, to put it mildly. This company actually has a pretty simple business model, I think, in my opinion. I think it's a good one that a lot of beginner investors are going to be able to understand, that are going to be able to grasp. And it's not something like a semiconductor company, something like a Cirrus Logic or maybe a Skyworks Solutions, something that might be a little more difficult for a newer investor to understand and comprehend. As for the platforms they have, we're going to go over all those first before we get into the balance sheet and all the other stuff we're going to get into in this video. First off, the first platform we're going to go over, and the biggest one, which I'm sure you guys have been heard of in the past, is Tinder. At the end of 2019, this platform had 5.9 million subscribers. They monetized their platform by using Tinder Plus, which was launched in 2015, and Tinder Gold, which was launched in 2017. Subscribers can also pay for things such as super likes and boosts on a pay-per-use basis, so they can generate revenue from that as well. They also have Match, which is the name of this stock and this company. Match was launched in 1995. On launch, you can search profiles, receive algorithm matches, and attend live events with other subscribers. Another platform they have is Meetic, which is primarily a European online dating platform. It's based out of France, so if you're from the United States watching this, maybe you haven't heard of this. I had not heard of it either. This was actually launched in 2001. It's very similar to Match, so I don't feel the need to talk too much about that, because if you understand Match, you'll understand Meetic pretty easily. They also own OkCupid, which was launched in 2004. This platform attracts users through a Q&A approach, which I think is very unique, and I think that eliminates a lot of the lost time that you get in a lot of these dating platforms. But the major portion of this platform, it actually comes from major cities in the United States. Also, it's also involved in the UK. But they're also seeing some increasing growth in India, so those are the three main markets that they're going after. There's also Hinge, which I'm sure a lot of you have heard of as well. This platform was launched in 2012. It's relatively new, I guess you can say, over the last 10 years or so. This is more popular among the millennial generations, as well as the younger generations, the younger than the millennial generations, that is. Match originally was an investor in Hinge, but they ended up purchasing the entire company a couple years ago in 2018. Another platform they own is Pairs, which was launched in 2012. This is the leading provider in dating products in Japan, and it also has a presence in Taiwan and South Korea. Then there's Plenty of Fish on top of that. Plenty of Fish was launched in 2003. This platform is similar to Match in regards of how the platform is laid out and services within the platform that they are offered. This platform especially has taken an increase in popularity over the years since it was launched, and it has appeals in the central US, Canada, the UK, and as well as other international markets. Then the last platform they offer is Our Time, which is the largest singles dating platform of people over 50. This is offered in both the United States and the European markets as well. As for the subscription packages that are offered for these products, they mainly range from 1 to 6 months. Some might do a year, but mainly they're 1 to 6 months, and then you can renew them after that. It's up to you to decide whatever you want to do, which means the revenue business model is recurring. As you guys know, I really like recurring revenue business models, so that was a check mark right there in my book. They also do generate revenue from advertisements on these platforms, but their primary source of revenue is through subscriptions. As for their most recent quarter, they did just release earnings on February 3rd. Their adjusted earnings were 48 cents a share. I released this on my TikTok, and I kind of gave my little thoughts on it and just what the earnings were on TikTok, so make sure you're following me on TikTok if you're not. Potato Finance, go check it out. The link's in the description. But 48 cents a share, that was actually flat year over year, and they actually missed analyst expectations by about a penny, which really does not concern me at all. I find this actually super impressive to me that they were able to get this close to earnings and they were flat year over year, because guys, if you weren't aware, there was a pandemic that went on the last, basically the entire year. We're coming up on the year mark of it, believe it or not. I know that's crazy to even fathom, to even think about, but we're coming up on that year mark where no one was really allowed to leave their houses, which means there really was no dating involved. And even when the world started to come out of shutdown mode, even when the world started to not be in lockdown, people didn't want to go out immediately and go to see just people they didn't really know. They didn't want to go and meet new people. So it was pretty tough for these platforms especially to really come back and really start bringing in revenue again. I mean, really tough, guys. So the fact that they're flat year over year, I find that absolutely outstanding. I love that. Fantastic. A+ job in my book. That's just my personal opinion, of course. Anyway, back to the most recent earnings. $651.4 million in revenue, which is up 19% year over year, compared to $648.8 million that analysts expected. So that's a pretty solid beat right there. Average subscribers increased 12% year over year to 10.9 million. And this was actually really surprising to me, believe it or not, because, well, like I just mentioned, the world was shut down. And then when the world opened back up, people didn't want to go see too many people. Now I think we're getting to the point where, as I've mentioned in previous videos, people are like, well, if I get it, I get it. It's not the end of the world. I'll recover. It'll be okay. It's going to be all right. Because they just can't take being home anymore. I don't blame them. Believe me, I don't blame them at all. People need to just get out, and I completely understand where they're coming from. But the fact that they were able to grow subscriber count double-digit percentage, that is fantastic. I find that phenomenal. I really like that. I really like it a lot. As for the 2021 revenue guidance, they gave a range of $2.75 billion to $2.85 billion, shattering the expectations of analysts, which was actually under $2.4 billion at $2.39 billion. ARPU was up 5%, or average revenue per user, year over year from 59 cents to 62 cents. ARPU is higher in North America, which makes a lot of sense because a lot of companies have higher ARPUs in North America, but more specifically the United States. ARPU more specifically in North America was 66 cents per share, up 7% from 62 cents in 2019. And internationally, ARPU was up 6% from 56 cents a share to 58% a share year over year. Adjusted EBITDA was up 13%, increasing from $216 million to $245 million. Adjusted EBITDA margin was actually down year over year in spite of that great earnings. It declined from 40% to 38%, so it was more like flat line. It wasn't like it dropped 15% or anything like that. They also had free cash flow up year over year, 23%, up to $746 million from $608 million. Their total operating costs and expenses did increase dramatically year over year from $365.8 million to $438.8 million for a 20% increase. This was largely in part due to the in-app purchase fees. Looking at their balance sheet before we get into the other stuff about what I like and dislike about this company, they have an effective tax rate, when I did my math out, of 5% over the last 9 months, which is actually pretty low and very surprising in my personal opinion. They also have cash and cash equivalents of $739 million, up from $465 million year over year. Total current assets of $1.02 billion compared to $3.7 billion last year. This mainly stems from the separation from IAC, because there was a lot that went into there and they obviously had to give IAC some sort of benefit to let that deal go through. The total assets declined from $8.3 billion to $2.9 billion. This is clearly in large part because the non-assets of discount operations, again, has to do with the separation deal. Total current liabilities of $500 million compared to just over $1 billion last year. This is likely due to current liabilities of discount operations, which again is in effect of the IAC deal. Long-term debt increased by $700 million. They had to take on some debt when separating from IAC. That is why there's such a substantial increase here from last year, as well as the effects of the virus the first part of the year, because they were just probably burning through all of their cash flow because, well, no one was doing anything. No one was going anywhere. They had probably no revenue. They weren't bringing in a ton of new subscribers. I would imagine those early points of the year. Stockholders' equity is actually negative. It's almost $1.2 billion. That is not something I love, but again, that's probably has to do in large part with the IAC deal to get separated. Although it looks bad now, it's probably not a big long-term concern. So bottom line, there might be some concerns at first glance of this company, but it's not the end of the world. I think a lot of this is mainly due to that IAC deal. Obviously, in the short term, it looks bad. Over the long term, I think this would benefit this company. So now that we've gone over that, we've gone over the business model, the balance sheet, that type of stuff. We're gonna go back over to the whiteboard. We're gonna talk about like my opinions, what I like about this company, what I dislike about this company, those type of things. To start off, recurring revenue business model speaks for itself. I don't need to go into too much detail here. Recurring revenue business model, I mentioned there's a ton of time on the channel. It's easy to project revenue, it's easy to project subscribers, easy to project growth, all that stuff, very, very easy. Well, easier, let's put it that way. Secondly, they're in different markets. They're not only in the international market, they're not only in the United States market, they're in both, and they're diversified in both. And I don't think I mentioned this actually, but it's actually pretty split down the middle where they get their revenues from and where their subscriber count goes. It's actually very, very interesting how it's barely that even. Obviously, I think I would like to see the United States take on a little bit bigger portion of that, just because it's a more profitable company. It's a more, I guess, enriched company, you could say, for lack of a better term. Don't hate me out there if you're from any international waters. I don't mean that any bad blood or anything like that. But it's not like Pinterest where they're just strictly focusing on international markets or anything like that. Something I really would not like, something I really wouldn't be too keen on, and we'd probably be singing a little bit of a different tune if that was the case here. So they're very diversified. Speaking of diversification, they're diversified in different age brackets. And what I mean by that is they're not just focusing on, say, millennials or Gen Z or Gen X or whatever the case may be. They're focusing on platforms where they have, for ages 50 and up, they have millennials, they have younger than millennials, they have a lot of different markets, they have a lot of different age brackets they're going after. I really like that because I don't think this should be like a one-size-fit-all platform. I think they should be able to reach out to different age brackets and pull them in, because that's just going to bring in more revenue, it's going to bring in more people. So I really like that. I find that very unique. Last earnings, killed it. I love their last earnings. Earnings per share year over year were flat. I love that when no one was allowed to leave their house. I'll take that all day long, baby. That's a W in my book. Dub Nation. They're still growing. Revenue, subscribers, adjusted EBITDA, operating income. They're growing all of these things in a year where no one can leave their home. And keep in mind, this is the first year that they were separated from IAC. That's fantastic. That's a very tough hand to be dealt. I love it. I love it. I love it. I love how these numbers are growing. I can only imagine what's going to be like in 2022 when the world goes back to real normal, not the new normal. When it goes back to the real normal, I see this company doing very, very big things. Now, a couple more things here, and then we got one big one to wrap up the likes here. $750 million revolving credit facility. I love that. So say this virus doesn't go away in 2022 for whatever reason, and it's around for 2024. They have $750 million they have access to whenever they want. That's a lot of money, especially for a company like this. That's a lot of money. I love that. I love it. I love it. More money equals more things that can go wrong. I love it. And then they have a low effective tax rate, okay? Low effective tax rate, obviously that speaks for itself. The lower money you get taxed, the more money you have to put back into the business, or if you start paying dividends or something like that to your company, you basically just have more money at your disposal is the bottom line. Now, the last point here, I now write this on the whiteboard, and this isn't gonna show up in between the numbers. This is something you really just have to see. You have to really understand, I guess, not so much macroeconomics, we have to understand the psychology of people. You have to really take a notice of how people operate, and it could be, somewhere where you live, could be when you're on vacation. You really have to take notice of this, and you really have to kind of see these trends. And this is not something you can teach. This is just something you have to see, because it's not like, all right, you just divide this by this and you get this number. It's like you just have to see it and you have to have that knack for it. Where is the world going? Where is the world going? Look at it this way. You just spent the last essentially year not wanting to talk to people, not wanting to be around anyone. So the habit's built there. Look at things before that. Obviously, in some states, in some areas, it's different. People are very friendly. In a lot of states, people don't want to be bothered. People don't want to go to the grocery store and meet someone. They don't want to go, I don't want to say out on a Friday night, but they don't want to go to all these places. They're afraid to talk to people a lot of the times. They really are afraid to communicate. It's very hard to put yourself out there, especially in this day and age when everything's so social media based and all these things. You can message someone on Instagram, Facebook, you can do anything like that. So it's easier because you're not face to face. Do you really think people are going to come back and go more towards coming to that face to face interaction? Probably not. I'd find that hard to believe. They're going to want the more convenient answer. It's much easier to meet someone on a dating app and then go meet up with them as opposed to oh, let me try to talk to this person over there. I'm not saying there's anything wrong if you're like that. By no means at all. There's absolutely 100% nothing wrong with that at all. I'm just saying more people would rather have that convenience. And I understand why. They'd rather have that convenience of swiping on a phone and then meeting up with that person, then seeing what happens. They'd much rather have that than just that initial icebreaker. I truly believe that. Now, in addition to that, where do people meet most of their significant others? Where do a lot of people meet their significant others? At work, right? At work. As I've talked about in so many of these videos, what is going to happen most likely when this virus subsides? A lot of people are not going to go back to work. A lot of people are going to stay work from home. There's a lot of great reasons I've talked about on this channel, so I don't need to go into too much detail. Obviously, it's going to save the company money. It's going to save the company time. It's going to save the employees time. There's a lot of reasons why people are not going to go back to work. As I mentioned, and I can't remember what video it was, I said I wouldn't be surprised if at least 50% of people did not go back to work. At least. Obviously, in corporate office, if you're like a teacher or a waitress or something like that, you're going to have to go back to work. A doctor, you're going to have to go to work. I'm sorry, but you're going to have to go. You're just going to have to. But look at it this way. People who don't go back to work, they don't meet those people at work. So those single people, they're going to want that interaction. So they're going to want to be on these platforms more. Especially if they live by themselves, they're going to want that interaction. They're going to want and go out with someone. They're going to want and try new things. They're going to want and meet up with someone. I don't blame them. It makes complete sense. I'm just saying that is where the world is going, in my opinion. I really see this blowing up. And on top of that, they have a monopoly of platforms. They have all these platforms. Hinge, Plenty of Fish, Tinder, Match, all of these platforms. It reminds me of Facebook. It legitimately reminds me of Facebook. Because look at it this way. Facebook bought out WhatsApp. They bought out Instagram. They were buying out competition so they could create a social media giant, a social media monopoly. And I view Match as doing the same exact thing. That is how I view this right now. That is how I view this. Huge. This is where I see the world going. I think this is the next big thing. I don't see people going back to the way it was back in the 50s and 60s where you actually had to call someone if you wanted to hang out with them, if you wanted to go on a date. I don't see that happening. I find that very hard to believe. I find this is the way, especially that up and coming generation, those people that were born in 2000, 2003, 2005, that generation, I think this is going to be the big thing. I truly, truly believe that. Now, let's move on to some of the risks I see with this company and some of the concerns I have, because every company is going to have some sort of concern. There's nothing that's just like 10 out of 10, 100 out of 100. There's going to be some things that might be 9.8 out of 10, but there's never going to be like a 10 out of 10. There's always going to be something wrong. So first thing that I have concern, App Store fees. How is this going to affect the company? How are these fees are going to affect the company? Obviously, iOS 14 is going to affect companies in big ways, especially in the App Store. They currently pay Google and Apple 30% of their revenues. 30% is a lot, okay? That's a lot. It's a third, just about a third of the revenues. So how is this new iOS 14, how is that going to affect their revenues? Are they going to have to pay more? How much more are they going to have to pay? It's something you got to take into consideration. What are they going to do? Are they, there's tons and tons of scenarios here. You don't know yet, obviously, but it's a risk. Something you got to take into consideration, something you got to account for. Secondly, this is a big one I have. This next two are very big. Sex trafficking. That's a big one in my book. So obviously you saw this with Uber, you saw this in Lyft. What if, and I'm obviously not going to go into too much of a colorful detail here for a lot of different reasons, but what if you meet up with someone and something happens? How does that affect the company? Obviously, it could be a scandal, there could be something sex trafficking related comes out. You can use your imagination to decide however you want, whatever you want to decide with that. But what happens? How does this company handle that? Or maybe not even that. Maybe it's not even that dramatic. Say, for example, you meet up with someone and a woman gets their purse stolen or something like that. That's another thing, and that happens a couple times, and all of a sudden Tinder and Match are having these issues. Like with this happening, people don't want to go on those platforms anymore. Maybe they want to go check out Bumble, What happens with that? It's a risk, it's something you have to take into consideration, and it is possible. This isn't unrealistic, this is very possible. This one, the first one, that's obviously gonna happen, but I don't see that being as big of a concern as this one and this next one I'm gonna talk about. So this next one, and this one really sticks out in my mind, is what is the next big vision of this company? What is the next big vision? Obviously with Facebook, Facebook's always turning, Facebook's always moving, Facebook's innovating. I can see it, and I can see it innovating. With Match is a little bit newer in regards where I don't know where that next big product is. And now go in a little more detail here. Look at Amazon, for example, for say. Amazon has this great idea and you're like, wow, can Amazon ever top that? And all of a sudden it's like, boom, they got another idea. Like once that idea comes out, they're like, miles past that idea. Like that's on the back burner. They have the next great thing on their plate. And I can attest to that because even like YouTube, like my very small business I have, look at it this way. So when you see a video, by the time you're seeing this video, I am like miles past it, miles. Like if you follow me on Instagram and I don't post anything about it, it's because I completely forgot I scheduled the video to upload. Because by the time this video uploads, I am miles past that. I am way on to the next idea. I am way on to the next venture, whatever it may be. Maybe I'm looking into a new stock. Maybe I'm reading about a stock I own. Maybe I'm filming a video that I'm making for the Monday upload per se. Maybe I'm writing a script, whatever the case may be. I am miles past that. And with Match, I'm like, what can they do next? What can they do next? What can they do? How can they take dating to the next level? Obviously, like we talked about with one of the platforms, they can use more of like a streaming video chat thing. I don't know if that's gonna work because I feel like at first glance, people don't want that face-to-face interaction, so I don't know if that would catch on. So that's where I'm really stuck here. I'm looking at this, I'm like, where can they go next? What can they do to stay a dominant player and one-up it? What can they do? Like Amazon, like I said, good example, they did pharmacy, grocery stores, time after time they've gotten involved. Facebook, Instagram, WhatsApp, the stories, communication, they just keep one-upping it. What can Match do? What can Match do to make this valuation make sense to me? What can it do? But at the end of the day, I honestly just gotta do a little more work on this company. I really wanna look into it more and find out what that innovative project can be, what that next innovative thing can be, that next game-changing product that Match can put out. Like I said, because they are like a Facebook. I do view them very similar to Facebook because they are buying these companies, they are bringing these new platforms, and they're just building a monopoly like Facebook did. Obviously, the tech giants get broken up. Facebook has to separate from Instagram, and YouTube has to separate from Google. If that actually does end up happening, I find that hard to believe. I really wouldn't be surprised if Match was next on that list. I guess that's another risk I could have included in there. Like I said, I don't even think this is really going to happen because there's just too hard to draw a line in the sand. But it could get to a point where Tinder has to separate from Match, and then Plenty of Fish has to separate, and they all have to become independent companies and competitors. It could happen. I don't think it's going to happen for a lot of reasons because it's too hard to draw those government guidelines. But at the end of the day, I'm not buying this yet. I need this valuation to come down first before I can even consider it. I feel much more comfortable as an investor buying this stock at between $90 and $100 a share, probably close to like 90 to be honest with you, because that would put the forward PE at about 40, which this is a growth company. Obviously, this is not a value company because this company is on the come up. So I would feel much more comfortable paying a 40 forward PE for this company than what it is right now. And it's at some ridiculous night right now. I can't remember off the top of my head. I think it was like 280 when I looked at it this morning. So I just feel more comfortable paying that forward PE of 40, okay, as opposed to a true PE of 280. But like I said, I want to find out that innovative product. That's the first thing I got to do, the next innovative product. I got to find out what game-changing product can they create to one-up this monopoly, to even put that competition further behind them. But until I figure that out, I can't buy this company. But anyway, guys, in saying that, that's the end of this video. Thanks so much for watching. I really appreciate it. If you do get some value out of this, please drop a like on the video. That really does help me out. Like I mentioned in the beginning, that does just push this video out to a whole newer audience that can get value out of this as well. If you haven't subscribed yet, what are you waiting for? Hit that subscribe button, turn on the notification bell so you don't miss any future uploads. Let me know down in the comments what you think of Match, if you've done any research on it, if you own it, what price you feel comfortable buying at it. Whatever you want to do, guys, leave it in the comments. I'll get back to you as soon as I can. I love hearing from you guys in the comments, and I'll see you guys in the next video.